Investing money into the stock market can be risky, and that is what holds most people back from starting. Unfortunately, that's also what keeps them from building wealth. If you want to start investing but have some doubts, there are a few basic wisdoms that I have picked up over the last 10 years since I have been investing, and they help me minimize the risk and maximize the gain, so maybe they will help you too. Number one is to only ever invest your own money. That means that you should never take on a loan to invest into the stock market, because taking on a loan is already a risk for you personally in itself, and then investing that money into the stock market increases this risk even more. People go bankrupt over this, or at least end up with huge amounts of debt. So that is something you should never do as a private investor. You might already have heard that there is good debt and there is bad debt, and bad debt is usually associated with consumer loans, with high interest rates, and that doesn't generate any income for you. And now you can investments into the stock market to that list. The good debt, on the other hand, is investments into assets that then generate a return for you. That, for example, can be education, or buying something that has an immediate return, or at least some value in itself, like real estate. And even real estate can be risky if the price of the house drops suddenly, but it will probably not go to zero as it might be with stocks. And investing in your own company is also considered a good debt. Now you might think, well, stocks are also assets, and if they pay dividend, I do have a return. That's only half true, because taking on the loan, it's a liability first, and the asset only second. And the return with stocks only comes over time, it barely comes short term. At least not for us private investors. Number two is to only invest money that you don't need in the short term. And that is because the market goes up and down all the time. It's also called market volatility. And only over longer periods of time, and by longer I mean at least 10 to 15 years, has the market returned overall gains. But it requires patience. And you can never be really sure when it's gonna go down. So you don't want to be in a position where you have to sell your stocks when the market is down just because you need the money for whatever. Because when you buy stocks and the price goes up and down all the time, it's only an accounting loss or an accounting gain. But only when you sell it for a certain price, you will realize the loss or the gain. So please have your short-term financial needs met before you invest your money into the stock market. Number three is don't put all your eggs in one basket. And all your eggs means all your money that you decided to invest. And the basket means one company. So the underlying important principle here is diversification. Because by investing in more than one company, you reduce the risk of losing everything. It doesn't happen very often, but if it does, you can drop to zero. And not that long ago, there was a spectacular bankruptcy of a top 30 company in Germany. It went bankrupt due to fraud. No one expected it, or let's say almost no one expected it. And a lot of investors lost a lot of money with that incident. So if something like this happens, and it's what we would call market risk, and your position is 1% instead of 100% of your portfolio, then you're obviously much better off with the 1%. That is why I practice myself and also preach on that channel, especially for beginners, is to invest in broad, low-cost index funds. And when I say beginners, what I mean is everything up to a net worth of at least 100K. I dare say there is no easier way to diversify than this. Number four, only invest in what you understand. And that is also crucial for beginners, because there are many different options out there that you can invest your money in, like invest in crypto or invest in watches. Let me take stocks as an example, because that's the way that I approached this when I started out. So a company needs money in order to do what they do. So they offer shares in return for money. And with that money, they finance their production and their innovation and everything they're producing. And the shareholder, in return for giving the company the money, owns a little fraction of the company. And by that can benefit for when the company grows or also pays dividends. So the way I see stocks is really people going to work every day, doing their thing, providing value, collecting money for that, and then I can benefit from that too. And I mean, you don't need to know everything in detail. There are people who make whole PhDs over one singular aspect of the economy, but I think it's important that we understand the principles of the asset class that we are investing in. So for example, you don't need to know in detail how cryptocurrencies work. I certainly don't, but you do need to understand that it is basically a currency that has been massively speculated on, which is the reason why the prices go up and down very fast. And it's also highly unpredictable. So be sure to understand the basic concept of how something works before you invest in it. Number 5 is a German one. It's called Hin und her macht Taschen leer. And I haven't found a proper English expression for it, but it that translates to back and forth makes pockets empty, just that in German it rhymes. And what it means that as a private investor, if you buy and sell stocks very often, you lose money. And I think that's for two main reasons. The first one is the cost, because with every transaction there are transaction costs. And the more transactions you have, the higher those costs are going to be. And another cost factor are taxes. The second reason is market timing, because of course in the stock market our overall goal is to buy low and to sell high. But by trying to time the market, what you might end up doing is buying high and selling low. That's what the data shows happens to a lot of private investors, and that's obviously not what we want. And that directly brings us to my next point, which is time in the market is better than timing the market. That is also my favorite one, and I'm constantly trying to remind myself of it, because it can be tempting to trying to time the market. But by investing regularly and also staying invested over the short-term fluctuations, you allow your portfolio to grow, and also important to compound over time. When you try to time the market, and I also have fallen into that trap, you keep delaying to invest because you're waiting for the perfect moment, but at the end you buy and you sell at not ideal time points. Because of course in retrospect it's always easy to say, oh yes, I should have bought there and I should have sold there. But well, if it were easy, everyone would do it. So that is why Charlie Munger said the first rule of compounding is to never interrupt it unnecessarily. And number 7 is personalize your portfolio regarding to your risk tolerance. And that refers to asset allocation. So how much of your portfolio you allocate to different asset classes. And there's been at least one study, if not several, that show that the investment policy, so this allocation to the asset classes, is actually more important for the performance of the whole portfolio than the investment strategy itself within the asset classes. So practically that means that you should decide on your asset allocation before you even start investing. So you decide on how much you want to keep in safe assets like cash, certificates of deposits or bonds, and how much you want to put towards the risky part like stocks or real estate. So deciding on that allocation and sticking to it over the years is one of the most important and relevant things you will do in personal finance and investing. And of course you can adapt it over the decades depending on your age and also on your financial goals. I personally was heading for an 80-20 split until a couple of weeks ago, but then I talked to a friend and he told me, you could rather go for 90-10, so 10% safe investments and 90% riskier investments. And it sounded reasonable for me, so that's what I'm doing now. But of course that's a very individual decision and depends on your risk tolerance. There were a few other wisdoms which I didn't conclude in this video on purpose because I consider them a bit controversial. One example is don't try to catch a falling knife. That refers to a single stock that suddenly falls that one should be careful to buy in case it keeps falling and hurts us in the process. And there will be cases where that is true. There might also be cases where this means that you can buy low and then later sell high. So depending on the stock and the history, this can also be a good thing. Another one was the trend is your friend. And I see that it can be true to just follow the market, especially when it means to buy the whole market like we do with the low-cost index funds. On the other hand, following the crowd when investing can also be treacherous. There is a reason why investors say if your hairstylist tells you to buy a certain stock or crypto, that is an indicator to get out of the investment, unless your hairstylist is a professional investor. But since we are not stock pickers and market timers anyway, those two are not relevant for us. When you are now interested in transferring this knowledge into action, you might be interested in this video where I go through different and easy investment strategies. Thank you for watching and I see you in the next video. Bye bye.